You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
Today, I have the honor of interviewing the man that Bloomberg and BusinessWeek named the top 50 most powerful people in real estate. I'm Kathy Fettke, and welcome to The RealWealth Show. Doug Duncan is Senior Vice President and Chief Economist at Fannie Mae, where he's responsible for forecasts and analysis of the economy and the housing and mortgage markets. Prior to joining Fannie Mae, Duncan was Senior Vice President and Chief Economist at the Mortgage Bankers Association. And he's here with us today on The Real Wealth Show. Well, Doug, welcome back to The Real Wealth Show. It's such an honor to have you back.
Glad to be here. Thanks for inviting me. That's a big deal for an economist to get invited back.
Well, last year it was a lot of fun because we took a look at your forecast and then what really happened. And we get to do that again, look at your forecast from last year and what really happened. And let's see, did you forecast some kind of black swan event last year?
Oh yeah, we were all over the COVID in January. Yeah, that was a shocker. And obviously things didn't turn out anywhere close to what anyone thought.
Mm-hmm.
But I would say that the recovery of the economy has been stronger than what people thought once it did hit.
Yeah.
And we were ahead of the curve on that. We beat the average, I would say, in the forecast on that. But the housing piece, we were way out on the housing piece. So in April, so a month into the most serious part of the COVID, the board of directors at Fannie asked me how far a house price is going to fall. And I said, well, actually, they're going to rise. And they really wanted an explanation of that. That's where the value of our consumer survey comes in. Since June of 2010, we've been surveying 1,000 households a month. When we did the March and April surveys, what you could see was people who owned a home, because we could divide it by that. People who owned a home that they could have listed for sale were much more concerned and pessimistic than people who could be first-time homeowners when they saw the level of interest rates and they had secure salaried jobs. So we said, look, the number of sales are going to fall in the spring buying season, but supply is going to fall further than demand and prices are going to go up. They didn't believe it, but it turned out to be absolutely true. And so that's one of those insights into people's behavior and attitude, which has been really important in understanding where the economy is going to go.
Absolutely. And you came out with your 2021 forecast and recently revised it upward. So let's talk about that and why.
Yeah, you bet.
Starting with GDP.
Yeah, the story in 2020 was the virus. The story in 2021 is the vaccine.
Mm-hmm.
So if the vaccine is broadly distributed, is effective, and is resilient, and there I'm talking about if other mutations of the virus come, is the vaccine still effective, still resilient? That's what's going to bring people out into the economy. Their savings rate is 50% above the long-term average savings rate. So they've got savings, even if they're not evenly distributed across all income groups. Stock prices are up strongly. So if you have a stock portfolio, you've got wealth you can tap on there, and home equity because of this rise in house prices. So consumers actually have significant resources to draw on when they become confident to get out into the economy and be active. So our forecast suggests that will happen about mid-year. Now, this is something we've never done before, so we're watching the logistics. If you take the current pace at which the vaccines are being distributed and simply do a linear trend, it gets you somewhere to the July-August timeframe in which that plus herd immunity probably makes everybody feel safe. If you believe there will be some efficiencies as we learn about this distribution, then maybe it's June. So that's a way to think about the risk related to that. Now, not everyone will go out the day somebody says it's safe. Some people are like, well, it might be, but I'm going to wait and see if it turns out to be true, right?
Yeah.
So our assumption mid-year says in the second half of the year, people will come out, whether it's third quarter or fourth quarter. And we think with all that resource base that they've got, that we may see second half annualized growth north of 6%, which would give
Wow.
about 5% for the full year. So that's a pretty good year. And
That's amazing.
for housing, we also don't see interest rates going very far because spreads have been very wide and profits very strong in 2020. They're coming down, and the 10-year Treasury is coming up a little bit, but lenders can give up some of that profit and still keep the business flowing, and that will hold mortgage rates pretty close to where they are today. That means for housing, another good year.
That's incredible. That's maybe not what we thought, like you said, 9 months ago. Well, you did think so.
Uh,
So then the big question is if people start going out in the summer when things are warm and we're feeling more confident, does that mean people will be moving back to the cities and moving out of the suburbs, or is the trend that we're seeing going to continue?
Great question. And I believe the proper answer is we don't know.
Hmm.
But there are some clues. So one of the things that we can track the address of a person who is making a loan application for a property at a different address because you have to fill out all this paperwork. So we know where you're living, we know where you would like to live, so we can actually track migration through the mortgage application process. So we've got charts that show, no question, New York, San Francisco, Boston, Chicago, a number of the cities that have concentrated urban cores saw a significant rise in people moving away from density. So we know which zip code that address is in, and we can know what the density of population there is. We know the zip code that they're moving to and the density of population there. Put it on a chart, it's very clear. People were moving away from density. Now, the last couple of months before the early fall months, those lines started reversing themselves, meaning that activity was slowing. Then the virus picked up again, then that activity picked up a little more. What I take from that is there are amenities in densely populated areas which are desirable, not to mention employment, and proximity to your employment being one of them. And there are gains in productivity from working in close proximity to people. I know you're in California, you spend time in Silicon Valley. All the startups will tell you you got to have a small group of people working intensively together over a significant time period to explore an idea. That's true in the big cities too, with other kinds of business. So I'm a skeptic about whether there will be a permanent shift away from the city. I do believe that there will be a reduction in the amount of time each worker spends there. Because we have learned you can do some things from home. And houses are cheaper further away from the city core. And if you only have to commute 3 days a week versus 5, you might go that extra 3, 4, 5 miles and get that less expensive house. Or
Hmm.
maybe it's already there because it's owned by a boomer and they had 4 bedrooms. You may only have one child, but if two of you have to work at home part of the week, you might need 2 offices. So
Hmm.
2 of those bedrooms might get converted to offices. So a number of interesting dynamics at work.
Fascinating. And then, of course, we know one of the biggest issues that housing is facing is not a foreclosure crisis at all. It's a lack of inventory on the market. So if people are feeling more confident, maybe that means they're more confident next summer to list their houses and move. Do you see the inventory situation loosening up a bit in the summer and having more on the market, or not so much?
We do. Sorry, yes, we do see a response. Going back to what I said earlier about the survey of existing homeowners who were more concerned about the virus. Of course, on average, existing homeowners are older than first-time home buyers. And
Mhm.
so there is a recognition that the virus has greater risks for older people. So the more of that fear that you dispel, the higher the probability that some of those people who wanted to move but were fearful of the virus will actually now list their house, and that will increase supply. Of course, we have a couple of other things working here. One is over time, there is an if the economy does strengthen, that will push base interest rates up. At the margin, that will price a few people who would be buyers out. So demand pace of growth slows. Um, we do have a bunch of people that are in forbearances. Some of those will not recover their economic strength and be able to retain that house. And so some of those loans will go through either pre foreclosure sales or foreclosures. That will add a little bit to the supply side. And of course, builders are building as fast as they can. So whereas house prices increased about 10% in 2020, we think maybe about half that, or 5% in 2021, because of the combination of those factors.
So prices would still rise, there'd still be demand, but it would get closer to equilibrium
That's
by
correct. That's
okay.
correct. And long-term average nominal price appreciation, that is including inflation, going all the way back to World War II, is about 3.75%. If you take out 3% inflation, you get to about three quarters of, I'm about a quarter. Let me do my math here. Three quarters of 1% inflation adjusted house price appreciation. So at 3.75 with inflation, 4.5 to 5%, still stronger than the long-term average. So that's still strong price appreciation. It's just closer to the long-term average.
So do you see any kind of risk of oversupply at some point? I mean, I believe it's obviously not confirmed yet, but I believe that there was some talk that the Biden administration um, would put some money towards building more affordable housing. We know lots of builders are coming in trying to keep up with demand. Is there the concern that things might flip and we'll have too much supply at some point?
Um, Not immediately, but you said at some point. That's certainly a possibility. The thing I've been thinking about is the the growth of institutional investor money in single family rentals, along with builders who are building a portion of developments for sale to investors who will then rent them out. Now, part of the returns to those institutional investors is the cash flow return, but part of it is the capital gain return as well. So let's suppose that the existing home supply picks up and goes back to something close to normal, then the pace of price appreciation will slow. And question what the return targets are for those institutional investors, and the impact on price of the additional new rental properties being put into that space. Whether or not there would be a point at which some of those institutional investors would say, well, doesn't look like we're going to get a return targets, and start putting those properties on the market. That's a place that you could see in select markets some price compression because of the supply side finally catching up and overtaking the demand side of that market. But it's not here today,
Mhm.
and it probably the demographic bulge in the millennials probably suggests that's a fear maybe 2, 3, 4 years further out, but not a high fear even at that.
Well, and that's a really great point about the demographics. When you look at the millennials, I think the largest group of the millennials is around 28. I could be wrong about that, but that there would be a buying wave once they reach the typical first-time home buyer age of 31. At least it has been in the past. So, do you see that as a possibility that we will see more demand for these millennials as they start to form their families and want to buy homes like other generations have done? Do you see that there being strong demand in like 3 years from now?
Yeah, I think we're still at or around the peak of that group. So and they're a very large group, the largest population group we've ever had. So there's still going to be strong demand from that group for at least the next 2, 3, 4 years for sure. So other than interest rate shocks or some employment shock, I see housing as going to be a pretty good place to be for a while. There has been some concern about the boomers, and if the boomers move out, is that going to generate some shock? Well, they've got even more incentive today to remain in place than what they had been expressing for the last decade, that they want to age in place. Of course, healthcare has extended life, so that the fear on that side keeps being pushed out into the future further. I think the leading edge of the boomers is now, I might get this wrong, 73 maybe. One thing that is notable is that I believe the data are that between the ages of 65 and 75, the incidence of disability increases by a factor of 6. What
Hmm.
that means is expenditures on adaptation of those houses to be more age friendly. So it's things like replacing door knobs with handles, having places that you can roll a wheelchair directly in and not have to go up steps, showers which have safety bars and things like that. There's, I think, 6 or 8 adaptations that a typical house needs for that aging person to remain in place. I think you'll see expenditures on that, and they'll continue to age in place, which means you won't get that supply glut for some time that would drive price down.
Yeah, it's so fascinating how yeah, and I've been in the media most of my life. I got my degree in broadcasting, and sometimes these articles just take headline news and get more play than say yours, somebody who's been in the industry. But we saw that headline that baby boomers were going to be giving up all these millions of homes. There'd be a glut of inventory, and that there'd be a glut of inventory from all these forbearances, and really that's just not the case. I mean, so many of those forbearances have been extended and most likely will turn into loan modifications, don't you think, versus
That,
foreclosures?
that's right. I think in the initial stages, the share of loans that went into forbearance was about 8%. That's now down to 5%. And we have data. We surveyed people and said, why did you take a forbearance? About 50% of them took it as a precaution. They
Mhm.
were still paying, wasn't a problem. It was cheap, easy to do. So let's take it as an insurance policy. Then when they saw how things played out and they didn't need it, they extinguished it. So now it's something like less than 5%. Some of them are still paying fully on time or partially on time. Those are going to be candidates. Some of them won't even need a restructuring. Some of them will be candidates for restructuring, and that's the economically optimal way to solve the problem, is to keep the family in the house and restructure the obligation. But there'll be some that won't be able to make that. And if they have equity, pre foreclosure sale lets them escape fulfilling their obligations, taking a little equity to relocate. And then there'll be some that will go through the foreclosure process. So it will be a distribution of things. But we don't see this as some sort of a wave that engulfs the mortgage business as a whole.
As you know, there's certain cities that have been hit harder by the pandemic than others. Does your research show which areas are doing better and where more people are able to afford properties versus other areas?
Well, one of there's a couple of questions buried there. One is, in terms of general economic activity, what's the difference geographically across the country?
Mhm.
As has been politically sort of a flashpoint, there's no question that those geographic areas which had less severe lockdowns have performed better economically. So and the distribution of that impact, whether you're seriously locked down, the income groups that suffer the most from that are the lowest income groups. If the less severe lockdowns, they do better. But the question then is, what's the incidence of the disease? So there's clearly a trade-off. It's a very uncomfortable conversation publicly, but there's clearly a trade-off in those two things. From a housing perspective, housing always does better where jobs do better. I mean, I make sort of a dark joke about the 2007 to 2009 downturn. one of the things that we learned was if you're going to lend money to someone and give them 30 years to pay it back, it's a really good thing if they have a job. Um,
It
so
helps.
housing housing always performs better where jobs and incomes are growing. So there is that correlation between the impact of public policy relative to the virus and what's going on in the housing space. I was just going to say the one thing to note in this downturn, the rental space has actually been impacted in very different ways than the rental space was in the 2007 to 9 time period. Renting actually did very well in the 2007 to 9. In Fannie Mae, our multifamily business never lost any money in that very severe downturn. This time, however, that discretionary spending falls on workers who are hourly wage workers, and the homeownership rate in the leisure and hospitality category of hourly wage earners is only 43%. So it's whereas the national average is about 65%. So that's why you're hearing all the discussion about eviction moratoria is because it's been much more heavily impactful on the renter population.
And specifically in multifamily or across the board?
More so in multifamily.
Mhm.
It is, and we've had many conversations with investors and others in your area about single family rentals, which there are many households that own two, three, four, five rental properties as a supplement to their other income. The renters in that space have a much more even performance across cycles. So it's in the apartment space that there are is more volatility. So the single family rental space it has performed quite well during this time period.
Absolutely. I mean, we did a survey with our members at RealWealth and found that they were actually having a higher collection rate than normal
Interesting.
and even stronger applications. But we're focused on the growth markets and
Mhm.
where the demographics are going. The people who own property in California were definitely having a harder time, especially if they were self-managing and couldn't really keep up with all the regulations.
Right, right.
So in that case, do you see an opportunity for investors to be buying some distressed multifamily?
The the performance to date has been pretty good
Mhm.
in the multifamily space. There will probably be some, perhaps in the 5 to 50 category. That might, some of the mid-size apartment buildings. There's some evidence. The um, the there's a little story in the high quality, that is the A quality properties, that is the higher income rentals,
Mhm.
which ties out to ownership. So we watch things like lease renewals and rent payments on time to try to keep monitoring on quality. One of the things that we saw is that rents in the A category have actually declined more than rents in the B and C space. So why would that be the case? So if you are a renter in an A property, you probably have the income to buy a house,
Mm.
and you may decide, I was going to buy this house 3 years from now, but I want to get away from this virus, so I'm going to buy it now. So remember
Mhm.
the chart I was talking about earlier that showed the uptick in the move from dense to less dense geographies. So if you're one of those A renters, now you move out, buy a house, you don't stay in the A renter pool. If more than one of you in a property moves out, now there's going to be discounts offered to get lease renewals up. Well, if you are an A property renter in a different property and you see discounts at that one, you still want to stay in that area, you let yours expire and you put a new lease in this other building, right? So
Mhm.
there's a little bit of a musical chairs issue that took place that was derivative of the flight away from the virus that impacted returns in the higher quality properties in some markets, not everywhere, but in some markets. So the question is how fast the value is restored. Well, there have been a very long march of apartment rents rising for many years since the early 2000s. It's tipped down the last few quarters, but it's hard to say that won't reverse itself if the virus gets under control. It really comes back to the virus and the vaccines.
Sure. Okay, so just a couple last questions. Do you see is there any chance that uh, that Fannie Mae or Freddie Mac would increase the number of loans, investor loans that an individual can have? I know the limit is 10 now. Do you see that changing?
Actually, the regulator has placed restrictions on that, and the change in the SA agreement with Treasury also has some restrictions on that. So, unless those restrictions are revised at some point, that's highly unlikely.
So, but it will probably stick with 10, or could that?
Well, the way the SPSA agreement is stated, it is a percentage measure as opposed to a number, but it will be constrained below the 10 probably.
Wow.
So
And then,
I can get you I'll send you some details on that.
okay, all right. Wow. And then for multifamily lending, or that you don't see changes there?
There are uh, there are some changes that have been made in the requirements of the distribution of credits that we offer. I don't have the details right in my head at the moment, but I'll be happy to send those to you as well.
Okay, great. We'll put it in the show notes. And finally, we have a single family fund. We, do what the big guys do, but we do it on a smaller level.
Mhm.
Will there be more liquidity for single family rental funds or not?
Well, there's a proposal in the it's not a formal proposal yet, but there's discussion of the Biden administration having another stimulus plan in which they would address single family rental owners and tenants. So what the exact dimensions of that are, they are paying attention to that as an important segment. So I would say keep tuned to
Hmm.
see when a formal proposal comes, what it will contain on that front. But it is something that they're thinking
And there's still talk of the $15,000 tax credit for first time home buyers. Is that still?
about. Yeah, there's discussion of it, but like I say, there's no formal proposal out there yet. So these
Mhm.
are things that they are, I guess, testing in the
Mhm.
marketplace of ideas to see what kind of a response they get.
Sure. So it sounds like potentially more demand, even more demand
Right.
coming.
Well,
Yeah.
that's right. That's a
Mhm.
demand side factor, right? It's not. It would have to be some sort of a subsidy to builders to increase the supply side of the equation.
Mhm. Well, Doug Duncan, it's always a pleasure to have you here on the Real Well Show. Thank you so much for taking the time.
Thank you. Thanks for inviting me. Great to be back, and good luck to you. Stay healthy.
Thank you. And we'll continue to do so here on the Real Wealth Show because it is our mission to raise wealth consciousness. These are things we don't learn in school, so we got to learn it on podcasts. It is our goal to help as many people as we can create real wealth, which we define as having both the time and the money to live life on your terms with the people that you want to spend that time with. You can find out more. There are over 500 webinars on our website all about tax benefits and asset protection and which markets are best to invest in. It's free to access at realwealthshow.com. I'm Kathy Fettke, and thanks so much for joining me here on The Real Wealth Show. We'll see you next time.